Welcome, everyone. We'll probably have a few latecomers. We're having a little conversation going on right now, so you can see in the postings. So tonight we have Maria Young as our guest. For those of you who have never met Maria Young, she is one of our professors that teaches in our BB404, which is the Accounting and Finance for Craft Brewing, and he is a specialist in accounting for alcohol. That's at least what I think. So, and for those of you coming to the Craft Brewers Convention, she'll be in our booth and also at our party, and I hope a number of you are going to show up there. But without further ado, I'm going to let Maria take it away, because she knows we're in sort of the winding down part of the class, and you're in the part where we're actually trying to really hammer the details of our financial part of the craft sheet. So those will all be pretty much wound up for this week and next week. So this was a great time for Maria to come in and clarify a few of the points on the sheet, and also tell us like what really happens in that she's going to be teaching, like what's going to happen in terms of more in-depth coverage of those particular accounting sheets. So let's mute myself unless I can bear it.
Okay, thanks, Mellie. Can you guys hear me okay? So my name is Maria Young, and I'll be teaching BB404. And so I wanted to frame up what you've done so far with the accounting work and give you some context as how we'll roll that into next steps going forward, and give context as to the work you've done so far. Where does it fit into your financial statements at large? So let me advance the slides. So far you've done some homework. You know your estimated costs. You know that you know exactly how much it's going to cost you to make your product, and then what your margin is going to be. So we're going to take these estimated costs and then format it into a completed plan. Usually the process starts by walking through, doing your homework, doing some research, and then once you've got that data, then you put it into financial reports that you can take to either banks or investors, or maybe you're lucky enough to be able to finance it out of your own pockets. But for the most part, you're going to be presenting that information either to banks or investors. And they have certain expectations of what they want to see. They'll want to see, you know, a professionally formatted profit and loss statement, balance sheet, and cash flow statement. So what you have right now is a basic profit and loss statement. But to get ready for those investors and to get further into taking the next step, you'll need the balance sheet and the cash flow statement. So these are those kind of three financial documents that are critical to moving forward down the path to opening your own facility. We're going to go over this quite a bit in BB404. So you're wrapping up 202 now. Marketing is next. And then your in-depth financial work comes in BB404. So one of the easiest ways to look at this is with an example of financial statements to show you how it all pieces together. First, we're going to dive into the profit and loss statement. The profit and loss statement shows you the performance of an entity over time, and it answers the question, am I making money, or when will I start making money? And as you know, it's got three sections. You've got your revenue, then your cost of goods sold, and your operating expenses underneath that. So if we take a look at an example, this is, there's actually 2 pages here. So I'm going to show you the first page quickly and then over to the second page. So you can see again back to page 1, we start with sales up top. The very top line number is your gross revenue. This is all the money that you're bringing in throughout the year. And then the second line, your cost of sales, is your cost of goods sold. So that's the ingredients that go in and other expenses that go in to make your product. So if you take your cost of goods sold and subtract it from your sales, you're left with your gross margin. And then you always want to be cognizant of what that gross margin percentage is. When I'm taking a look at financial statements and I've got a P&L, the first thing my eye goes to is percentages. And I think percentages is great because it allows you to compare operations of different sizes, and it gives you a quick thumbnail glance of where the health of the company is, and it allows you to see our ratios in line with where you expect them to be or what is glaringly out of whack. You're not going to be able to pick up on that just looking at dollars, but those ratios are really critical to basic baseline analysis. So your gross margin percent is your gross margin divided by your cost of sales. If you think about this profit and loss statement, that sales as a top line will always be 100%, and then every other line item below that is a percentage of your sales. So underneath your gross margin, you've got your expenses. These are overhead expenses and then other expenses that you incur throughout the business that are not directly related towards making your product. Payroll is always going to be a really huge expense. And then you've got things like sales and marketing, depreciation, leased equipment or rented equipment, insurance, rent, of course, and then taxes, including things like payroll taxes. And we're going to come back to depreciation in just a moment. But when you get down to the bottom of that, you've got your operating expenses down here at the bottom, and this 492, 480 is a sum of everything that comes above it, likewise for years 2 and years 3. Then if you go on, you've got interest expense and other taxes. These are going to be things like other income taxes or other perhaps excise taxes down here, and you get your net profit at the bottom line. So the way these numbers work, you have your top line right up here, which is the gross, less your cost of goods sold gives you gross margin, and then you're left with your gross margin percentage, which is a really important percentage to have a handle on. From this gross margin number, then you subtract all of your operating expenses, subtotal of which is right here at the 492. And then you go over and subtract out any other expenses like interest or taxes, and then you're left with your net profit. The percentage down here, the 7.75, this is your net profit divided by your top line revenue. And that's also a really critical component because it's showing you, how much money are you making. At the end of the day, maybe you have a really great gross margin. So if you go back to page 1, maybe this is super healthy, but then when you get down to your net income is anemic. That might be because some of those operating expenses are out of line with where they should be. So that's just a very basic look at how you read the profit and loss statement.
Can I ask a question to give them some ideas here?
Yeah.
When, I think you and I have had this discussion about where should people be in terms of the percentage profit over sales if they're, making under 5,000 barrels per year. I think we've seen a few of these things around. I mean, I have an idea, but I'm interested to have you give your opinion, what you think people's net profit as a percentage of sales, what they should be shooting for.
Well, in this example, I think the 44% that you see in this example is too low for gross margin in the alcohol industry. I think your gross margin probably wants to hover more towards 35 to 40%. And then your net income percentages, I think of 10% as being kind of stable, and I think of 15% as being healthy. One thing to note, though, is that it's really different depending on what particular industry you're in and how your business is set up. So if you're a restaurant and a brewery together, if you have a full brew pub, then your margins might be different than if you were just a brewery. So there's a lot of things to consider in that way. Notoriously, restaurants are going to have margins that are lower than something that's just running alcohol alone. But the two can be a really nice symbiotic relationship, especially in the early years. If you have a restaurant and a brew pub, then your brew pub can be sustaining. It can help with cash flow and sort of buffer you through the growth years as a brewery until your brewery gets to the point where you've got solid distributor relationships in place. You have a lot more ability to scale as a brewery, but it takes more capital investment and it's a longer time period to actually get up and running. And I mean, it's a big machine, and you got to get that big machine moving. and that takes time. So having a brew pub, even though it's lower margins, can help buffer that along the way. Anyway, long story short, it kind of depends on your particular situation, but my thumbnail approach is I like to see, net profits hovering 10 to 15%, maybe more if the industry warrants that. Like, there are some things that take less money to make. Maybe it's cider, maybe it's something where your raw materials are going to be a lower percentage of your revenue than some other product. Do you guys have any questions or thoughts so far on this P&L? Okay, I'm gonna head over to the balance sheet and I'll keep watching for comments. So taking a look at the balance sheet, so you've got your profit and loss statement that shows the performance of an entity over time. And then you've also got your balance sheet. And the balance sheet is a financial snapshot of an entity at a moment in time. It answers the question, are your finances healthy? And other questions like, how leveraged am I? What's my skin in the game, if you will, on this entity? So the big difference between a P&L and a balance sheet is a P&L is looking at a period of time. And let's see, here we go. So you've got your assets, which is one side of the balance sheet, and then the other side of the balance sheet is your liabilities and capital, or liabilities and owner equity. So your assets always have to match your liabilities and equity. You guys probably remember that from basic accounting classes, but the two sides of it must balance, and that's the backbone of double entry accounting. So taking a look at what you might find on the balance sheet, you've got cash or cash equivalents. Then you've got accounts receivable. So when you're billing your distributors and before they've paid you, it sits in accounts receivable. You've got inventory. And then the sum of these three is your total current assets. And then you have long-term assets or fixed assets down here. Fixed assets are things like your equipment, your tanks, your furniture, computers. And then you have accumulated depreciation. And this is actually a contra asset account, which means that its natural balance is negative. So if you see your long-term assets or your fixed assets here at 750, your accumulated depreciation, this is actually a negative number. So the sum of the two equals this 739,800. And you'll often see the accumulated depreciation, it's usually presented in parentheses, which that tells you that it's a negative dollar amount. And then you add your long assets plus your current assets together, and you get your total assets down here. Do that over the 3 years. Each year, same type of information goes in the same bucket every year, but the values change. Then the other side of the balance sheet is going to be your liabilities and your owner's equity. So accounts payable, these are the bills that you have yet to pay. Current borrowing, this is any kind of short-term debt. If you have a loan from a friend, or if you have a short-term loan from the bank, something like that, it goes there. So the sum of those two give you your subtotal for your current liabilities. And then if you have any long-term liabilities, there would be a long-term liability section as well. In this example, we don't have long-term liabilities. Then you've also got paid-in capital, and this is what owners are contributing to the company to get it started. So you and another friend go in together to start a business, and you each put in $50,000. That $100,000 together becomes your paid-in capital. Retained earnings is the cumulative sum of how much the company has made from its inception point going forward. So if you think of it, year one of a company, you start and you don't have any income. At point zero, you have no income or loss. And then you go through the first year and you have income or loss, right? Let's say that's $5,000 of income. So at the end of year one, you've got $5,000 of income. And that is your net income. Let's say that's for 2015. 2015 net income is $5,000. Then at the end of the year, that current year net income gets rolled up into retained earnings. So then when it turns to January 1st, 2016, that which was prior year net income becomes current year retained earnings on the balance sheet. So the balance sheet, if the profit and loss lives on its own over a period of time, and at the end of the day, the final result of that P&L is your net income, that net income gets rolled up into the balance sheet year over year. And so all of the effects of the balance sheet, or I'm sorry, of the P&L over time live in this retained earnings number. So this is cumulative result of prior year's activities from the P&L. Then this next line is earnings, and that's the current year activity. So this is the current year net income. And then you've got total capital, which is the sum of paid-in capital, retained earnings, and current year net income. The total liabilities and capital together is your total capital plus your total liabilities. And then net worth is going to be just the capital portion. So oftentimes, this net worth income line is not something that you'll see on every balance sheet. In fact, it's a little bit superfluous here. We don't really need it. So your balance sheet would stop where you have your total liabilities and capital. And I just want to address one question over here from Brian. He asked, how often do you complete a balance sheet? You complete it as often as you run financial reports. So if you run them monthly, which is a great thing to shoot for, having monthly financial reports, then you would have a balance sheet monthly, or you do it annually or quarterly, whatever the period is that you're running reports.
Maria, could I ask, do you want to talk about depreciation now, or are we going to wait? Because I think that I haven't really covered that in class, and it would be good for people to have a understanding of where the depreciation might come into play, given they already know equipment costs and things, site, if they buy a building, blah, blah, blah.
Let me walk through the statement of cash flows just to introduce that statement, okay. And then we'll talk about some of that depreciation. Any other questions on the balance sheet real quick? Okay, if anything comes to mind, you guys just type it in. So you've got the balance sheet and you've got the P&L, and you understand how the net income from the P&L goes on to the balance sheet. Then the other big question that I hear time and again, especially from people who are getting into business. I mean, it's not just in the brewery or alcohol or cidery distillery space, but just anybody who's starting out in business. The question is, okay, my P&L says I made money, but I don't have anything to show for it, and where did it all go? So the cash flow statement shows you how you spent your money. And just because your P&L looks good or shows income doesn't mean that you've got cash in your pocket. Because if you think about it, it takes a lot of money, especially in an industry where you need to buy large equipment or possibly vehicles. There's a big outlay out front, and you have a lot of liabilities that you have to pay back over time. Either you're paying back liabilities for things that you've purchased, or you've got a bank loan that you're trying to pay back. And anytime that you pay back liabilities, that is an activity that takes cash, but you don't see it on the P&L. It's all balance sheet activity. And the cash flow statement explains what the difference is between, it ties together the cash on the balance sheet and net income on the P&L. It's the link between the two. So there's 3 sections on your statement of cash flow. There's cash from operations, investing, and financing. So if you think about operations, that's just the day-to-day of your business. Investing is things like buying equipment, things that allow you to expand or get better or do things in a new and different way. It's an investment back into the company. And then financing is purely cash that allows you to operate. It finances the operations. So in this example, we've got cash from operations. You start out with your cash sales and then cash from receivables. And I want to spend a minute to talk about cash from receivables. Let's say that you have a distributor and you invoice that distributor $10,000. and you create the invoice on, I don't know, March 30th of this month, and then you're not going to get paid from them until, let's say, April 15th. So there's a lag time there. But when you create the invoice, the way you record that sale is to increase sales and increase accounts receivable. And then when you actually get that $10,000 in April, you're going to increase cash and decrease your receivable. So if your accounts receivable goes down, then that means your cash goes up, but your sales stay the same because you booked those sales way back in March. So when you see this $821,689, that means for this year, year one, that they received $821,689 from what was sitting in AR at the end of the previous year. Then when you add your cash sales plus the cash from your receivables, you get your subtotal of cash from operations. And then if you've got a new investment received, maybe you had, I'm trying to think of something here. New investment received. If you got cash from, I don't know. I'm blanking. I'm going to skip that one. But you've got your subtotal of cash from financing. Okay, so let's say that this is a new investor who gives you $77,000. So you're going to have your subtotal of cash from operations, and then you've got a new investment of $77,000. The subtotal of those two gets you to $1,265. So up here, the $366 and the $821, those are operations. The $77 is financing, and then that's your inflow there. And then you've got your expenses, your cash outflows. You spent cash of $331,000, and then this bill payments, just like you had cash from receivables above, this is cash for payables below. So when you have things sitting in accounts payable and you actually pay those bills, it doesn't change your expenses, but it does change your cash. So the subtotal of cash from operations there, and then you're good. Down in the financing section, if you're paying back any debt, it would show up here. And then the subtotal of cash spent is your operations plus any pay down of debt, leaves you with your subtotal of cash spent. Your net cash flow is here, and this number is going to be the difference between your cash outflows and your cash inflows. And then you add this net cash flow number to your beginning cash balance, and then you're left with your ending cash balance. And you do that for the 3 periods. So it kind of breaks up into different sections and shows you how you are spending your money. So that is the cash flow statement. And I see Bill saying, I hope you can recommend a software package. Yeah, there's a reason why accounting software is a popular thing. I mean, you can imagine how convoluted this would get if you tried to do it in Excel. So I say, get yourself on an accounting software as soon as you start to have enough transactions that you're losing track of them. Get yourself on some sort of software. And there are a lot of them out there that you can choose from.
You're not going to suggest any like QuickBooks or something to start with?
QuickBooks is an easy one, yeah, and it's great. I like it a lot. They have different formats. They've got online formats. They've got desktop software, Mac and PC. So it's great. There's Xero. Xero is another web-based software that's known for being very user-friendly. But, you got to figure out what works for you. I'd say those were the most popular. There's another one called Peachtree, which I don't recommend. But, I would recommend talking to your accountant if you have an accounting advisor in your team, in your sphere of influence. You would probably want to talk to them and get their take on what they recommend. So I'm going to talk a little bit about fixed assets and depreciation. Do you guys have any questions on the statement of cash flows before I dive in? Okay. Okay, so you spend a lot of time figuring out how much it's going to cost to buy the equipment you need in order to get your operation up and running. And that might be things like tanks, It might be mills, it might be vehicles. Maybe some of you are even thinking about a building. So all of that stuff is really big ticket items. And fixed assets are large purchases that have an expected useful life of more than 1 year. So the concept is that if this good has a useful life of more than 1 year, then it's not appropriate to expense it all in the very first year, because you're going to get use out of it over time. So you want to try to pull the expense of that purchase across the economic life of it as an item. So let's say that a computer is going to last you 5 years. If the computer costs you $1,000, then you want to write down, in other words, you want to expense part of that purchase over the course of 5 years instead of taking it all in one fell swoop. And the concept of this is that you're trying to match the economic activity to the period. So even though the cash activity might be different, the economic reality is that you're getting 1/5 of the full use of that computer every year. So the way that we handle this in accounting is that the full purchase price of fixed assets that you purchase, they are put on your books at the value for which you purchased them, and then you depreciate a portion of that over time. So instead of, let's say that you buy a tank for $30,000, instead of having a $30,000 expense, you're actually going to put that tank on your balance sheet as a fixed asset. So if I go back to the balance sheet, so it's a fixed asset, a long-term asset. You would put that here with your other fixed assets, and then you would take depreciation of that tank over time. Now, in the case of breweries, a lot of brewery equipment is 7-year life, which means that it has an economic life of about 7 years. That's sort of the agreed upon lifespan for this class of equipment. So you're going to take a portion of that, and it's not exactly 1/7 because there are lots of complicated rules around it. But in a nutshell, you would take 1/7 of the price every year as an expense. And that portion of the price is considered depreciation. It's called depreciation. So the depreciation every year becomes an expense. And I'll go over to the P&L and show you where that lives there. So this depreciation here. In our example, we started with $750,000 of fixed assets, which you recall from the balance sheet. And then in year one, we took $10,000 of that $750,000 as depreciation expense. So the expense goes here on the P&L. And then you've got the accumulated depreciation, which shows up as the contra asset on the balance sheet. So over time, you're going to continue to depreciate that. If I go back to the P&L, let's look at how it happens over time. So you've got $10,000 of expense year one, another $10,000 for year two, a third for year three. And then if you go over to the balance sheet, this accumulated depreciation increases by the same amount every year. So here we've got our balance for year one. In year two, accumulated depreciation has accumulated the depreciation for year two. So it pulls up to $20,400, and then the same thing happens in year three as well. Now, if you had seen fixed assets get added in the years, if these numbers had risen, then you would more than likely see the depreciation change as well. And in the real world, you're not exactly going to end up with the same dollar amount every year, but this example gives you, an idea of what to expect. So as you've been working through your workbook and you're writing down all these things that you're going to buy for capital purchases, just understand they go on the balance sheet, not necessarily on the P&L, because the P&L is going to show you expenses, but when you purchase big ticket items, those aren't expenses, those are assets that you're purchasing. Mellie, what else could I touch on in this area that you think might be helpful?
Well, I think the other thing is, in the sheets I've given them, we also had the issue of inventory. So what should we be doing with the inventory that they need to buy at the beginning, or that they may be buying throughout the year? Where's that actually going to show up in the financials, outside of the fact that they know they have to have the money up front to buy all that to get started, but then what do you do with inventory over time when you have valuable bottles and such stored in your warehouse?
So when you have all the inventory on hand, that also lives on your balance sheet, which goes over on the assets section. So when you are first starting out and you're loading up and getting ready for the year to come, you would have a lot of inventory on hand. And inventory is it's purchases that you are eventually turn into sales for you. So you know, you're going to take all that grain you have on hand and turn it into something to drink, and then you turn around and sell that something to drink, and you make more money on it than you spent making it. Ideally, that's the way we hope it works. So as the goods that you create get completed and then sold, that inventory turns into a cost of goods sold. So if you imagine you create a barrel of beer, and that's going to take, you know, malt, hops, water, any other additives, and you add it together, and all that malt that you're taking down off of your, you know, out of your warehouse, that's coming from your inventory, but you don't move it. See, inventory here is one big line item, but in reality, there's a couple different aspects to inventory. There's raw materials, work in process, finished goods. So as you start the process of making your product, it's going to travel through those different parts of the inventory spectrum. So as you take grain off the shelf and start to make beer, you're taking it from raw materials, and then you're going to put it into work in process. And then as that, you know, finishes processing and you're actually ready to ship it to a distributor or sell it to your, you know, consumer, that once it's become finalized, that moves out of work in process into finished goods. And then finally, once you have sold that item, that's when that amount of inventory that you originally took off the shelf finally gets turned into an expense. At the point that it gets turned into an expense, that's also where you incur sale and where you recognize the income on that sale as well. So when you have inventory that's living with you, and it's either finished goods, raw materials, or work in process, it's here on the balance sheet. And it's not until you actually sell the good that it shows up over on your P&L as a cost of sales. So it's a timing thing. As you buy stuff, you put it on the balance sheet, and then over time, as you sell it, it goes over to the profit and loss account.
So I think one of the other interesting challenges, and I know you have a lot of clients who have brew pubs, is, you know, the inventory. The beer could be finished and sitting in a serving tank, and basically, how is that being accounted for? I mean, you can use TTB reports to tell them the status of different, you know, what's the status of your finished alcohol at any point. But what is your recommendation for, you know, interacting with the clients around, you know, serving tanks?
We always take measurements. We measure how much beer is left in the tank at the end of the month. So it's a monthly, you know, you can take inventory at any time, but I really recommend doing it at least once a month, you know, at the same time every month. And we'll take measurements of how much is in the tanks, and then apply the cost. So basically, for all of my clients, we figure out how much does it cost to make a barrel of X beer. Let's say that, you know, they have this lager, and we figure out based on the recipe of the beer how much it costs to make one barrel of that type of beer. And then if that beer is in the serving tank, then every month when they do inventory, they measure it. They say, okay, we got, you know, X amount of barrels in the tank, and then we just take that measurement and apply the unit price, which is calculated based on the recipe for the beer. And we say, okay, this is how much that we have of draft finished goods on hand in the serving tank in this month. And then you do that for everything too. So not only the serving tanks, but you're going to measure, you know, how many kegs do you have, how many cases do you have on hand. We also have our clients count how much they have for malt or hops. You know, there are some things that you just can't get a handle on, like yeast, and I pass on that. I just expense that when it's purchased. In a perfect scenario, you would find a way to measure that and take it over the course of time. But from a practical standpoint, we just expense that when it's purchased.
Mm-hmm. Brian has a question.
Yeah, Brian says, what's the cutoff for NAS? Cars, tanks, yes, bucket, mop, expendables? Yes, great question. So the answer is, it depends. The rule of thumb is about $500. So if something costs over $500, then it's probably going to be a fixed asset. You also have to consider what the intended use is. Are you intending to hold something for more than 1 year, or does whatever you have a useful life of more than 1 year? I mean, there's a lot of expensive stuff that you can buy that doesn't last a full year. Maybe it's just because you're buying in large quantity, but you just need to understand what the intended purpose of the purchase is. Another thing that you should be aware of is that for tax purposes, it changes a lot. For example, there are new repair regulations that the IRS has put forth recently, and repair regs say that you can take relatively low dollar amount goods and go ahead and expend them. Historically, kegs really were considered a fixed asset because they have a useful life of more than 1 year, and you intend to hold them for more than 1 year. So they would be something that would be capitalized, especially from a tax perspective. They would be capitalized, and you would not necessarily be able to write off in the year of purchase. Now, under these new rules, you do have the option to expense them in the year that the purchase was incurred. So that's another thing you have to consider. From a tax perspective, what are the IRS rules for tax? But then also from a book income perspective, how am I keeping my books? And I'll tell you that most people are going to keep their depreciation equal to what's done for tax purposes. If you are following GAAP, which is a set of accounting rules, generally accepted accounting principles is what that stands for. It's GAAP, GAAP. So if you're following GAAP, then there are a set of standards that are going to make your depreciation for your own books different than what you file on your tax return. But following GAAP to a T is a very labor-intensive endeavor, so most folks will just let their depreciation on their finances equal what was done on the tax return. Okay, let's see what's going on here. Jeremy says, in terms of property taxes, is there a lower limit on items listed for taxes? Property taxes is something that's ruled by different localities, different jurisdictions. So I'm not really going to talk about the rules around property taxes because we're all from different parts of the country. And in my experience, is there a lower limit on items listed for taxes? No, if I'm filling out a property tax return, I usually just use the same rule of thumb, like anything over $500, I'm going to report on the property taxes. Do you have to tag the equipment with a fixed asset? No, you don't have to tag the equipment. So what's going on with this audio problem? Can you guys not hear me?
No, I think it's probably just Bill.
Oh, okay. Anyway, yeah, you don't have to tag your assets. If you want to, that's great, but there's no reason why you have to. One thing I would recommend, this is something I run into a lot when keeping track of fixed assets, is let's say that you buy a tank and you got to put down a down payment and then the rest when it arrives. So if it's a $30,000 price tag, you're going to book $15,000, in 1 month, and then $15,000 when you take delivery. But then when it comes time to do the taxes, it's really complicated because you you're like, well, what was that $15,000? I can't quite remember. And I would recommend booking it all as a $30,000 item right to begin with, and then showing the other 15 as a payable that you have to pay down the line, because you want to be able, when you pull your fixed asset report out of your accounting software, you want to be able to know, oh yeah, I bought that tank and it cost me $30,000, not 15. So it's small potatoes, but it's a handy little piece of advice. So I think we're kind of getting near the end. Love to take any more questions you have.
Well, actually, we go to 8:15.
Oh, to 8:15. Okay.
Yeah, because we started at 7:15. We're on a weird time schedule for the class.
Okay.
I had one other question I think that might be helpful. It again gets into the brew pub situation. How often do you actually treat the pub versus the brewery as completely separate entities?
It depends on a couple things. It depends on whether or not you have different investors in each entity. If you have different people investing in the brewery versus the brew pub, then you may want to separate out those reports, because you figure, you know, it's not the business of anybody but who's involved in that entity. Another reason why I see them separated for reporting purposes is if you want to incentivize management, like if you have a front of house manager or a kitchen manager and you want to incentivize him or her based on the financial performance of the brew pub, then you will separate the entities. And along with that idea is, let's say that there's a brewery and a brew pub, and the brew pub buys beer from the brewery. Well, you want to represent that at an arm's length value, because if you're going to incentivize your managers based on the performance of the brew pub, you want to give a realistic picture. And if you keep selling the brew pub beer from the brewery for the amount of money that it costs you to make the beer, well, then you're always going to be bonusing your management, because very low threshold, because their costs are so low. So sometimes separating out the divisions is important so that you can get an accurate picture of how much things are really costing.
Great. I think there's a question from Janine.
Most brewers use standard costing or job cost model for production. Standard costing. Yeah, most of them are just going to figure out, and in fact, for production, in reality, what I see is that most folks are worried about their direct materials and applying some overhead, but the labor is usually kept out of it, at least for reporting purposes. I don't come across that many breweries who take the time and effort to do managerial reports where you're showing as a cost of their sales all the raw materials, all the direct labor, and all the indirect costs as well. That's not to say that it's not a worthwhile endeavor, but usually what I see in terms of reports is you've got your sales, and then in your COGS are going to go all of your direct materials going to your COGS, and then usually the payroll is just left all in operating expenses instead of having some allocated up into your cost of goods sold. It's a great idea to separate out your payroll and put some into your cost of goods sold, and then just have your operating expenses represent the payroll that's related to overhead or admin or management. But it takes an extra step of time and effort, and you need to make a judgment call on if that's the way you spend your money. Does that make sense?
Yeah, and I think the way that we've done it in class is the way you're talking about, where they can actually see what it would cost with labor and what it would cost without. But then when we do the cost of goods sold and the expenses, and overhead, those are put in separate categories. So the payroll was separated out from what the cost of goods sold and the revenue. Yeah. So that's the way their sheets are up now. Or you've seen, sheets. So.
Yeah.
No other pressing accounting questions, gang?
The common mistakes you see from startups like us or minds in many different directions. I think one of the most common areas I see is it's really hard for people to wrap their head around the fact, especially when you're talking to investors, just because there's profit either on the income statement or on the K-1 when you do your tax return, it doesn't mean it's cash in the pocket. So when new brewers are presenting their like one sheet for investors, when they're talking about, you know, this is our business plan and this is what you can expect over the coming years, a lot of times they'll show the profit over, let's say it's a 5-year projection, they'll show profit over the coming 5 years. And what a lot of times is lost is that that profit does not mean your investor is getting money. It means they're going to be on the hook for taxable events because they're getting taxable income coming into them, but it doesn't necessarily mean that they're going to get cash. And as an extension of that idea, another thing that I see with startup brewers is not setting expectations with investors on when and how they can expect to be paid back. And I highly recommend that you put some thought into this and sit down with your attorney as well and consider what language you want to put in about how distributions are going to be made. Because I guarantee you, the minute you start making money, your investors are going to be like pestering you and trying to seem not pestering, but they really are, because they're like, so how about my check? How about my check? When are we going to get paid? What does this mean? Blah, blah, blah. And you need to have your ducks in a row so that you understand, okay, what are my parameters? If I've got $100,000 sitting in the bank, do I give it to my investors? Am I going to give them a distribution to cover their tax burden, which is something I hear often, but I think is faulty, because 9 times out of 10, a brewery is going to be a foreign entity, which means that the tax happens on the personal investor level, not the entity level. And on the personal level, you have no idea what else is going on in your investor's tax situation. So if somebody gets a K-1 with $20,000 of income, that $20,000 of income from an investment is going to affect me differently than it's going to affect you, differently than it's going to affect the other investor, because there's other stuff going on. Maybe some of us have kids, maybe some of us don't. Maybe some of us have a job, maybe we're all just wealthy investors. Maybe we've got rental activity. So the point is, you never know how your piece of the pie is going to affect an individual's tax situation. So if you like go out of the gate saying, we're going to give you money to cover your tax on this income, I think it's faulty, because you don't know where they're going to lie in their tax bracket based on the other things happening in their situation. Furthermore, if you've got investors in different states, then you have state tax to consider. So if you are, like we're in Oregon, so if you have an Oregon investor and a Washington investor, your Oregon investor is going to have state taxes while the Washington investor has no state income tax. So I don't like the idea of basing distributions to cover taxes. I mean, if you want to give a distribution to sort of buffer the tax effect, that's fine, but I don't think you should put yourself in a position of saying, we're going to give you enough of a distribution to counteract, you know, any taxes that you might owe on your investment, because you have no idea of knowing what that person might owe on their investment. One thing that I recommend is saying, okay, we've got X amount of money of cash in the bank at the end of the year, and we need to hold back enough to cover our payables for the next however much we've got on the books. We want to have, you know, X number of months of operating expenses in the bank, and what are my capital improvements that I need to spend money on in the next 3 months. And then after you cross those thresholds, then that's your available money to distribute out. And then you also say, you know, you put in your language in the contract or in the operating agreement at the managing partner's discretion so that you've always got that fallback in case things don't work out quite as you think they might.
great question. Anyone else have some pressing questions? Because I think we should probably talk about the fact that in the next class, there's quite a bit of discussion and content around how you finance and the appropriate financial structure, which kind of ties into what Maria's been talking about.
So what else is on your mind, guys?
Usually takes people a little bit of time to think and type.
Have you guys all done your taxes? You know we've got like less than a month, right? That's where my mind is tonight.
Yes, we've had to steal Maria away from her very deep accounting season to come and be our guest.
Yeah, Janine, having an accountant on your team is, that's quite a win. That's good.
So I just, I think getting back to what people said about how often do people do the statements, what have you seen with some of the smaller breweries in terms of how often they do their financials, how often they ask you to run their financials for them? If they're a pub versus a brewery, it might be different.
Yeah, it seems to increase the more activity that you get going. So if you're just starting out, then, folks might have me clean up the books and look at them once a quarter, once every 6. But I really think that once you're rolling, you should be looking at your financials once a month.
Mm-hmm. And especially, I think the restaurant. I'm sorry. I just think restaurants, they tend to get a little more obsessed with food cost issues too. So then I see them wanting to go monthly reporting to see what's going on with their costs around food and labor.
Oh yeah. I mean, the clients that I have brew pubs, they're chomping at the bit to get the numbers as soon as they can after the close of the month. And a lot of that has to do with not only seeing where they came in, but also just gauging how food costs are changing, because food is something that you're ordering, several times a month. So it's not like you do one big order and then there's a lag time before you order again. So the more timely that data is to you, the more you can react and make good decisions based on what you see from the numbers.
Mm-hmm.
So it makes sense to finance a brewery building separate than a residence, even if they are on the same property. I guess I'd have to know more about that. My gut is to say yes, do it separately. Anytime you hold real estate, you want to hold it in a separate LLC away from any other of your activities. Pros and cons of leasing versus purchasing kegs. Well, I think leasing is a racket, and I would say buy them when you can. I don't know. Yeah, I think that leasing should be sort of a last resort. And I'm not a fan of one-way kegs either. They're expensive and they cut into your margin.
Very well.
Because one-way kegs, if you've got like a one-way pony keg that costs, God, I'm forgetting my numbers now, but it changed the margin on a keg sold from the margin went from 50% to 30% or something like that. So, well, I don't know. You be your own judge. I'm just giving you a sample size of one here.
Well, if you don't have the money for a lot of kegs, the leasing kegs is a good way to start.
Yeah, it can be. A lot of times you have to make trade-offs in the beginning until you're up and running with enough strength to, do things the way you want to do them. And that's the way it is in life, isn't it, right? Like everything's a trade-off. So if you really want to make it happen and you don't have enough money to buy the kegs, well, you find a way. But you could, wean yourself off them eventually have your own fleet.
A crazy keg habit. And Jeremy asked a question.
Well, what's your, well, I mean, I would say if you're just financing everything yourself, it's less of an issue. But if you're going to have different financing, either from an institution, in other words, a bank, or an investor, you want to have them separate. If you want to give a little more context, go into it. Janine, tell me more about separate entity, like separate for what? Separate from yourself? You definitely want to separate it from yourself because you do want that liability protection. Anytime you have an LLC, that's going to give you a shield of protection that separates your personal assets from your business assets. And when we get to 404, there'll be more discussion on this topic as well with an attorney in the class. But the short answer is, yeah, an LLC shield does separate your personal stuff from your business stuff. The reason why I say want your, Jeremy, I'll get back to that in a second. Okay. If you have a technical consulting company and you self-finance the brewery, I mean, then theoretically you could have it all under one roof, but then you have to think about the liability for each one. And like Janine was getting at, if you've got liability issues or both under the same umbrella, then the assets from the technical consulting company would be available for suits on the brewery side and vice versa. How involved should my accountant be? Can I keep track of the day-to-day and then consult an accountant for the report process? No, I should have an accountant at the beginning for setup and maybe once a quarter then tax season. Yeah, that's not a bad plan. I will say that the single best investment you can make on the financial side is a good bookkeeper. I mean, seriously, like, and bookkeepers, you know, the tough thing about them is that there is no certificate, or, well, there is a certificate. There's no credential like a CPA license, you know, that's licensed by a governing board, and that you have to have all these, you know, criteria met before someone can have the license. There's nothing like that for bookkeepers, and you get what you pay for. So I would recommend finding someone good, get recommendations from other brewers or other people in your network of who they use. But that, especially, I mean, if you're somebody who gets numbers and counting and kind of likes it, well, good for you. But if you don't like it at all, then definitely a bookkeeper, because before you know it, it's going to get all screwed up, and then it's a real trail of tears to unwind that ball of wax. So if you can manage and stay on top of the day-to-day, that's a great way to go. And then you can have someone look at your numbers quarterly. But if you are not the type of person who is going to stay timely and accurate with your accounting, then just hire somebody to come in for 1 or 2 hours a month and just get you dialed in once a month. What else? Mellie, I can't hear you.
Sorry, my dog was barking. I wanted to, let's see, Janine has one more question. QuickBooks is good?
Yeah, I like QuickBooks.
A lot of people do. It's probably the most popular entry level.
Mm-hmm. Definitely.
So I wanted to say thank you, Maria, for joining us tonight. And for those of you who are going to take that class, I think you're going to really enjoy it. That starts later in April, right? No, May.
May.
Mm-hmm. May. Yeah, because the marketing class is next, and then this one. 11th. Thank you, Megan. So I think people have found the accounting class to be really quite useful, and, well, finance, accounting, and legal aspects are covered. So it's very comprehensive, and it's a great chance to have all those questions answered. I really appreciate you coming tonight, and I look forward to seeing all of you and Maria at the all of you who are coming to the Craft Brewers Convention in Portland. We're going to have a great time, and hope to see you more in the future too. So thank you.
Bye. Thank you.
Thank you.